Now let us take the first part of the audit risk, which is the risk of material misstatement. Okay. And we have to keep one thing in mind very clear. It is a combination of inherent and control risk. And both of this comes from whose side? The client side. Okay, now I'll just give you a proper explanation regarding or maybe a visualization for you to understand how these risks will actually be understood by the auditor. Okay. Now, basically, inherent by the word itself, it says it is something that it cannot be avoided. It cannot be. That means looking at the nature, the size, okay? Because of all these kind of parameters, this kind of risk is always going to be there. Okay, now for example, suppose financial statements have been prepared. And suppose there is a new introduction of an accounting standard this year, or maybe there has been a new IFRS which has come up. Now, obviously, people are going to use the IFRS, apply the IFRS in the preparation of the financial statements. Obviously, these people are still not having the experience, do not have, because there is something new in the market, they may not be having the experience. So because of the lack of experience, 100% there is a possibility that what will happen, there is going to be a risk of misstatement. They could not be able to apply it properly. There could be some doubt in understanding the IFRS itself. There could be a possibility of not understanding the judgment, the assumptions, or maybe the language could not be very clear. So something or the other is going to be there, which is unavoidable, which we call it to be what? Inherent. It is going to be there. But then what happens is, we realize even the business by itself understands there is an inherent risk. So what they do to remove the inherent risk or to minimize the inherent risk, they will try to apply controls. Now, maybe if I understand that, yes, there is a new IFRS which has come up, then in that case, what I will do, for this particular year, maybe I would apply, hire a particular expertise. Maybe I would employ somebody who's an expert in this particular area. Or maybe I would appoint a reviewer who could review this particular work done by this accountant. Something I will try to do to establish a control to either recheck or supervise the work performed by my accountant. So I try to establish a control. Now, if suppose the control also fails, then there is going to be what? Risk of material misstatement. See, if there is inherent risk and if my control is very good, then the risk will be less. There could not be a mistake. But inherent risk is there, but my controls are also not working. Then the risk of material misstatement will be what? High. Okay. So what they're trying to say is the new IFRS is an inherent risk because application cannot be known very easily. For that, the management put some control. What control they put? They appointed a reviewer or maybe a person who's an expertise in this particular area to recheck the work done by the accountant while preparing the financial statements. Now, what happens if inherent risk was there, but if the management applied control over it? Okay, that means what happened? The entire risk of material misstatement actually reduced because the controls are very good. But now, is there a possibility that the person you appointed as the reviewer, okay, could not actually review the work appropriately, or maybe he was not available only that time when the review is to be conducted, or maybe he was at the very last minute he was not available, or something like that happened, because of which this control, though it was in place, it failed. Now, in this case, did this IFRS application got rechecked by anybody? No. So now tell me, when inherent risk was there, management applied the control, but the control failed. That means what? Is the risk of material misstatement less or more? It is going to be more. Got it? So when we talk about risk of material misstatement, we are always going to analyze what is inherent risk. And then if we see inherent risk, we always take into account assuming there are no controls. Then after understanding inherent risk, we'll see did the management could put control. If the management put control over it and the control is working very well, then the control risk is not there. But if the management's control is failing, that means there is control risk also. And if there is a control risk together, it is nothing but what? Risk of material misstatement. That means, see, it is a risk. First of all, understand it's only a risk. Risk means what? Possibility. Because understand, if the new IFRS comes, there could be a possibility that the accountant understood it very well. So he must have applied properly. But because it is new, there is a risk that he could do something wrong. Because of which we applied the control. And if the control failed, there could be a possibility that he could have applied the IFRS in a wrong manner. So what we are trying to understand is inherent risk and control risk together will give rise to risk of material misstatement. Is the point very clear? Okay. Now, when you read, the understanding will be even more.
Just Just for additional clarity, everything here is in the point of view of auditors.
Auditors,
Right?
yes.
When I go on audit, I see whether, okay, first of all, the new IFRS there, so there could be an inherent risk.
Yes.
Is the auditor's point of view again.
Yes.
Then I go ahead and check whether if there is any internal control set by the management.
Yes.
And again, it is auditor's point of view to check whether the control is working or not.
Correct.
And if it works, fine. If it doesn't work, it means
if it
that
works,
there
we
is
say, okay, risk in this particular area is
less. So accordingly, I'll be designing my detection
Yes, correct.
control.
Got
So
it? And see,
detection risk.
these two are not under our control.
Yes.
This only checking we can do.
Okay.
But they are not under our control. But detection risk is totally under our control.
Right.
Got it? So that's the reason I told inherent and control arises from whose side? Client side.
Client side.
Only checking is what we can do. But can we manage this kind of risk? No. But detection risk we can manage also, we can control also from our end.
Right.
Got it? All right. Yeah. Now, risk of material misstatement is the risk that financial statements are materially misstated prior to the audit. Why prior to the audit? Because detection risk is going to decide about how much you are going to perform procedures. But for this to understand, you have to check inherent and control, which will be present irrespective of the audit. Correct? So prior to the audit, what is going to give the scope for the risk of material misstatement to be present? Inherent and the control risk. Got it? Then. Now, see, misstatement could be either due to fraud or it could be due to error. During the year, when transactions have been processed or when the financial statements have been prepared. So there could be a possibility when the processing is happening, that time there could be a mistake. Or when financial statements are prepared, that time there could be a mistake. See, understand, accountants are doing the processing. Processing means what? From journal to the ledger, ledger to the trial balance, and then preparation of the financial statement goes to the preparation of financial statements. Okay. So what happens here is accountants are also human beings only. So they are prone to errors ultimately. So that also is an inherent risk only. Correct. Now to avoid this, what we do, we apply some controls. So what we do, we say one of the control would be this entire thing should not be given to one person. See that you segregate the duty everywhere. Let there be 2-3 people doing this work. So he will write the journal, ledger posting somebody else, trial balance preparation, financial statement somebody else. So here what we did, we put a control that what he is doing, his work is checked by him. What he is doing, his work is checked. What he is doing, his work is checked here. Correct? So we understood there is an inherent risk that there could be a human error. For that to control, we put what? Internal control. But now understand, if suppose these all happen to be friends, do you think the control is going to work or there could be a failure?
It will fail.
It will fail. Risk of failure. So, yes. So because there is a possibility the control could fail, we said inherent risk is there. For that, the management applied control, but the control also failed, because of which there came what? Risk of material misstatement. Clear? All right. Next. Now, there is one of the ISAs that we have 315, which talks about identifying and assessing the risk of material misstatement. Okay, so identifying assessing the risk of material misstatement is nothing. How do you identify and assess inherent risk and control risk? That is the meaning of risk of material misstatement. Got it? Now listen to this. The objective of the auditor is to identify and assess the risk of material misstatement, whether the misstatement is due to fraud or due to error, at financial statement level or assertion level, thereby providing a basis for designing and implementing responses to the assessed risk of material misstatement. So what we do is, we are going to first identify the risk of material misstatement. Correct? Identify the risk of material misstatement. How we do? We need to identify inherent risk. We have to understand control risk. So to understand inherent risk, we are going to study the entity and its environment. Correct? To understand what all types of risk could be present. And to understand if there is control risk, we are going to study what? Controls. Correct? So this is the way we'll be able to identify and assess risk of material misstatement. And misstatements could be because of fraud or because of error. And misstatements could be where? In the financial statements also. Or it could be in presentation, it could be in disclosure, it could be with regard to the amount, it could be with regard to the ownership, anything. So it could be at assertion level also. Correct? Now, and this is not the only thing we do. Based on that, we are also going to give a response. So we are going to design and implement response to the assessed risk of misstatement. So whatever risk we have identified, based on that, we are going to give what? response. Correct? So this is basically the objective of the auditor. So first what we say, we will apply ISA 315, where ISA 315 says, identify and assess the risk of material misstatement, whether it is due to fraud or due to error. And financial statement or assertion level, anywhere it is, you try to assess it. Once you assess, you cannot keep quiet only for the assessment, because we have to give opinion. So in that case, what is the next thing that you do? You have to respond to the assessed risk. For that, you could apply procedures are there. Okay, you would be communicating with management. Okay, you would be communicating with TCWG. Okay, so there'll be multiple things that you're going to do once you identify any of the areas of risk. So what are you going to respond? How are you going to design? All of that is going to be the second part of your discussion. So for this, right, basically we have another standard which we call it to be ISA 330. Okay, just for clarity, this first part is covered by ISA 315. And if ISA 315 you identify and assess the risk, then the action that you take, you'll do it as per ISA 330. Got it? So basically, there are two things that they're talking here. So did you understand the objective of the auditor? First, you identify and assess the risk of material misstatement. And misstatement could be due to fraud or due to error. And it could be at the financial statement or the assertion level. And once you identify them, then you can't keep quiet. Obviously, you have to further audit procedures have to be applied. So you design and implement responses to what? To assess the risk that you have identified. Is the point clear? All right.